Welcome, everyone. You are at a deep dive, which is a monthly program presented by Entrepreneurs Forever. And we have a hot topic this month. Everyone wants to have an expert to ask their tax questions to. And it took me, I want to say, almost a year of trying to nail down an expert for you. Erin Snyder is young, but oh, she knows so much. She works for Karen Vitt CPA here in Pittsburgh, and she's going to be our guest. I'm going to just do a little bit of housekeeping, and then I'm going to hand it over to her. We'll do some introductions, who we are. I'll just mention some upcoming programs. We'll have the presentation, and we do record the whole event other than the Q&A, because you may have questions you want to ask, like, gee, I didn't report this to the IRS. What do I do now? And you do not want that recorded. So it will not be recorded. And hopefully this is a safe space to ask your questions. Erin's not reporting anybody to the IRS today. And this will be recorded, and I'll also send you the deck afterwards. So I think most of you are already in our community, but Entrepreneurs Forever's mission is to empower all small business owners to grow thriving businesses that sustain their families and support their communities. We do business reviews for anyone who's interested in joining us and see if it's a good fit for you. Let us know if you'd like one of those. Upcoming, we have the January deep dive is going to be what worked and what didn't work in 2024 and planning ahead for 2025. I'm going to do that one with Doogie Levine, one of our other facilitators here at Entrepreneurs Forever. And we're doing speed networking. We're doing it with our members only on December 10th, Tuesday afternoon from 4 to 5:30. And we had a great reception to speed networking last time. So if you're a member and you haven't signed up yet, you can do that on our website. This one's important this time. This presentation does not take the place of professional advice from your own paid advisors. So hopefully it will be helpful, insightful. You'll get a few aha moments, a couple of takeaways, and maybe get your questions answered. But if it is actually really important and material to your business, please find out from your own advisors what you should be doing. So today's topic is one of our most requested. The facilitators all tell me that there are tax questions that come up in their peer group meetings. And many times there's not a person there who really knows how to answer it, which made it a perfect subject for one of our deep dives. I'm going to let Erin introduce herself and tell you about her background. She's a CPA in Pittsburgh who can actually explain things in English that you can understand. And I'm so delighted to be able to bring her to us today. So I'm going to stop sharing my screen and invite her to introduce herself and share her screen. If you somebody has some phones ringing, if you can just mute yourself until you're talking, that would be great. And remember, at the very end, we will have a whole half hour for you to ask your questions. But if there's a general question or you need something clarified as Erin's presenting, please type it in the chat and we'll make sure that we bring that up. So without further ado, you are on, Erin.
Awesome. Thanks, Deborah. And thank you so much for allowing me to be here today. I'm really excited. So I'm going to get all this set up. Hopefully you can see my screen and then let me know if it all looks okay.
It looks great.
Awesome. So like Deborah said, my name's Erin Snyder. I am with Karen Vitt CPA, and I'm just honored to be with you today to talk about taxes, and we're going to go over some small business tax savvy. So first, I want to just go introduce our firm. Like I mentioned, I'm with Karen Vitt CPA. We're a small public accounting firm in Zelienople, Pennsylvania. That's about a half hour, 45 minutes north of Pittsburgh. We're a pretty small firm. There's 7 full-time staff. The owner and founder, Karen, she's been doing it for over 25 years. And she and myself were the CPAs on staff. But we also have bookkeeping experts, a payroll expert, a QuickBooks Pro advisor, and then we have marketing and administrative directors. And we all love to work together and help our clients the best we can. While we have a lot of clients in Pennsylvania, we also serve not only businesses, but individuals, corporations, estates, and trusts. And we not only serve them in Pennsylvania, but we also have clients in Ohio, South Carolina, Virginia, Florida, California. We even have a few international clients. So we're well versed in a bunch of different tax things that I'm sure you don't even want to know about. But I've listed our mission statement on the screen in the front there. We focus on small to medium-sized businesses, and we're really passionate about becoming their trusted advisors to help them grow and achieve their goals. And we do that through our maintenance and advisory services, which I'll get into on the next slide. So maintenance services to us, that's our compliance items, things we do to help you stay out of jail. That's your accounting, your bookkeeping, your payroll, and your taxes. And a lot of CPA firms, they do focus on those maintenance services. Another part of our firm is our advisory services. And these are our robust training programs that we've developed over Karen's 25 years plus helping and serving clients, and as well as my own experience. We see that businesses, they reach a lot of obstacles and encounter a lot of things that they have to decide. So we've developed these advisory services to kind of come alongside them and help them answer businesses' tough questions, especially as being entrepreneurs. Things are hard and you're not sure the best way to go around it. So we try to come along our clients' side and try to help them grow and achieve the goals that they're looking to do. So a little bit about myself. I graduated from Grove City College in 2021 with a double major in accounting and finance, and I also have a minor in analytics. I had a few internships over my school career and ended up getting an internship with Karen before I started my senior year. And I loved it so much. She asked me to come back, and I graduated in 2021, started immediately with her upon graduation, studied and passed my CPA exam in 2022. I'm a small town girl, born and raised in Mars, Pennsylvania, which is another small suburb of Pittsburgh. And now I live in Zelienople. I love the people I work with, and I'm really excited to talk to you today about taxes because I love to hopefully lessen the fear that kind of comes around finances and taxes. But when I'm not doing tax returns, my husband and I, we love hiking, and we just went to Iceland for our second wedding anniversary. Highly recommend if you can to go. There's now direct flights from Pittsburgh to Reykjavik, so there's like no excuse. But now to get into the meat of it, small business taxation, what do you need to know? So I talked about this word savvy at the very beginning, and I wanted to define it for us. It means shrewdness and practical knowledge, especially in business. And so hopefully my goal is by the end of today that you come away with that savvy associated with taxes and feel empowered to make the best decisions for your business coming into the end of the year. So there's 6 topics that I'd like to go over with you today. The first that we're going to go over is what should I know about taxes? So the first thing you should know is your marginal tax rate, and that's the percentage of tax on your next dollar earned. And this comes into play with the federal income tax tables. So you'll see those tax tables listed here from the Tax Foundation, and how your income tax is figured on the IRS side is using these marginal tax rates. So let's say, for example, you earn $50,000 a year and you're single. How your income gets taxed is $11,600 of that $50,000 is taxed at 10%. Then the difference between $47,150 and $11,600 is taxed at 12%. Finally, the difference between $50,000 and $47,150 is taxed at 22%. So it's kind of like a ladder. And it's important to understand what your marginal tax rate is so you can know how much do I need to set aside at the end of the year for my taxes and how much of my income is actually going to be taxed. And then I've also included here some state-specific taxes. Like I mentioned, we're a PA firm. We handle a lot of PA clients, but every state has its own tax law. So here in PA, we have a flat 3.07% state income tax rate. But other states, they either don't have state income tax, such as Tennessee or Texas, and some of them kind of follow the federal tax rates, like Ohio. So be sure, if you're not sure how your income's taxed in your state, check with your tax pro, they'll know. Also, I have listed here the local tax. This is a flat 1% tax on your earned income. And some municipalities, they charge more. Like the city of Pittsburgh charges 3% on your earned income. But the majority of localities, they tax 1%. And so your earned income is your W-2 and your business income, but not all of your income is taxed at the local level. Some notable exceptions are your interest, dividends, rental, retirement, S corporations. Those don't get taxed that extra 1%. Some additional taxes that you should know about, we'll start with the self-employment tax. And this comes into play if you have a business profit and you report your income on a Schedule C, where you have self-employed income, such as a partnership. And this self-employment tax is 15.3%, and it's basically you paying your portion of Social Security and Medicare. And this is in addition to that ordinary income tax rate that we talked about a little bit ago. So let's say again, you have $50,000 worth of business profit. Not only, and then you're in the 22% tax bracket. So not only is that 50,000 taxed at the ordinary income tax rates of 22%, but you also get hit with the self-employment tax of 15.3%. So be sure you're taking that into account as you're trying to save for your taxes and planning and making sure you have the cash available. Another tax is called the net investment income tax, and that's 3.8%. And this is levied on higher income earners. So it's only on your investment earnings, such as your interest, dividends, capital gains, rental income, royalty income. There's a few others. And it's only levied if you have an adjusted gross income, which is a tax term of greater than $200,000 if you're single and $250,000 if you're married. These last two, again, they're not super applicable all the time, but the 0.9% additional Medicare tax is on high income earners again. So be aware, if you earn more money, the government wants you to pay more in taxes, basically. And then this last one, the alternative minimum tax, it's on earnings greater than those limits I've listed there. And it's really not applicable for most taxpayers, but pretty much what you have to do is if your income's above those limits, you recompute your tax with alternative rules. And if you're not sure if that's applicable to you, check with your tax pro or ask me later and I can get into it some more. So now that we know about all the different taxes you may have to pay, we want to know, how does it get taxed? So there's two main schools of thought, the accrual basis of accounting and the cash basis of accounting. And we'll go over the accrual basis first. With the accrual basis, you record revenue when it's earned and you record expenses when they're incurred. So let's look at an example. Joe owns a business. He invoices his client for $5,000 of products he sold. And then that same day, he received an invoice from a supplier for $2,000 of product he purchased. Under the accrual basis of accounting, Joe would record $5,000 of sales and $2,000 of expenses today, regardless of when he receives payment or when he pays out. And let's say he would end his tax year today. Joe would pay tax on $3,000 of net income, which is the $5,000 of revenue minus the $2,000 of expenses. And this is regardless if he didn't take any of that money out of the business. That's the accrual basis.
Or whether it's been paid or not.
Yep, exactly. So since he sent out that invoice, that's sales. And since you got that invoice from a supplier, that's expenses. So it doesn't really depend on when your cash goes in or out. But the other school of thought, it's pretty intuitive. Cash basis, you record the revenue when the payment's received, and you record the expenses when the payment's made. So again, same example. He invoices a client for $5,000 and he receives an invoice from a supplier for $2,000. Let's say the next day he pays the supplier invoice and then he doesn't receive the payment from his customer until 1 week later, which is in a new tax year. So under the cash basis of accounting, you would record your sales in the next tax year because that's when you got payment. And then you would record the expenses the day when the payment was made. So let's say that next day your tax year ended. You have a net loss of $2,000 and you would pay tax on that because that was the only money that was paid or received um, prior to the tax year ending. So those are the two main schools of thought. You usually elect one or the other whenever you start your business. So if you're not sure, there's a little box on your tax return that says which one you are. So if you had someone do your taxes last year and you're not sure, check that out. And if not, ask your tax pro and they can explain which one is better if you're trying to start a new business.
Erin, if you
Mhm.
like set up QuickBooks for your new business, does it automatically give you one of those systems or the other? Like, what if you never really made a decision? How do you know which one you're using?
Yeah, so most people are doing cash basis, whether they know it or not, because in QuickBooks, when you set up your company, you're probably going to set up your bank account at the same time. And you're only recording the transactions when they're coming into your bank account. So a lot of people are cash basis. But QuickBooks, it can be tricky, especially if you do invoicing out of there, because it gives you both options. It will let you toggle on your reports between accrual and cash. So be sure you're checking that out. Usually it defaults to one or the other, whichever one you selected first.
And for most new businesses, do you have a recommendation?
Most of the time, cash is easiest because that's going to be the easiest way for you to know. It makes intuitive sense. When cash comes in, I record the sales. But some types of businesses, if you're invoicing a lot, then accrual basis could be better, but I would usually recommend cash basis.
Thank you.
Yeah, for sure. So now we know all about taxes, how they get taxed, and all the bases of accounting. So let's talk about entities and the different choices you have. So I have this very simple diagram. It kind of shows the different options you have, and we'll get into more detail on the next slide. But you can see that which entity you should be kind of depends on how many owners you have, and how much income you're bringing in. And here's some more details about each entity type, and I'll run through maybe some scenarios on which the pros and cons of each. So
And you will get this deck. So if you can't follow all of this, don't worry, you'll have it as a reference later.
yes, absolutely, thanks. So let's start out with saying Joe, he cuts lawns for a business and he's starting out and he's my client. And he comes into my office and says, "Hey, Erin, which entity should I be?" I'd probably recommend if he's starting out to either be a sole proprietorship or a single member LLC. He's the only owner and they're the easiest entities to start up. The sole proprietorship, you don't really have to file any paperwork. You just start doing business and you pay your taxes on your 1040 on the form Schedule C. Now, let's say Joe, he's a little anxious. He's hearing some rumors that some other clientele has been suing this other lawn care business. So he's like, I don't want them to come after all my money. So then I would recommend for him to register as a single member LLC. And again, he's the only owner, and this single member LLC gives him limited liability. What limited liability means is if a client would sue him, they could only come after the business assets. His personal assets are protected. So that's a great option. It keeps things very safe. And in order to create an LLC, all you do is register with your state. So if you're a resident of PA, you'd register an LLC with the state of PA. So let's say Joe's growing, he's doing great in his lawn care business, and he wants to bring his brother Jim on. So then they would become a multiple member LLC. And at this point, the business functions very similarly as the other ones. However, the IRS taxes a multiple member LLC as a partnership in default. You can elect as a multiple member LLC to become either an S corporation or a C corporation down the line as you continue to grow. And you can make that decision whenever is best for you. And usually it's not really easy to go back and forth between entities. So make sure that you're ready and you know all the pros and cons of the entity you'd like to be to know when and if you want to move.
What is continuity of life?
Yeah, absolutely. So continuity of life is, let's say you're a sole proprietorship and you pass away. That entity ceases to exist. It won't continue on unless you would like will it down to a family member or something, but that's the continuity of life. So the only entities that have continuity of life are S corporations and C corporations. They're treated by the government as more of a distinct entity and they have shares of stock, kind of like the stock exchange. So let's say if you are a shareholder of an S corporation and you pass away, those shares don't go away. The business can continue and you could will those shares to go down to your beneficiaries or another shareholder could buy you out. And so there's a lot of different nuances with the partnership S corporation and C corporation. I won't get into the nitty gritties because it really depends on your goals and what you're looking to do with your business, but these are all your options. Now, if you asked me and said, hey, what's the best entity? There's really no magic 8 ball. Really, what I would recommend my clients do is to choose an entity that furthers the goals you have for your business and develop a plan to best utilize the pros and cons of the entity that works best for you. Obviously, our goal is to make money, and we want to use the tax laws to our advantage, create a plan to pay those taxes, and help avoid surprises at the end of the year, while also claiming all the deductions and credits that are available to each entity type.
Erin, can you go back 2 slides to the one where you have the chart? Yeah.
Yep.
So are there rules of thumb in terms of how much money you're making before you should think about becoming an S or a C corp?
Yeah, so you'll hear the $100,000 mark a lot, and that is for gross receipts. So kind of like an industry standard is if you have gross receipts of about $100,000, then you can think about becoming an S corporation. And that really depends on if you're ready to take that next step, but that's an industry standard where a lot of people start thinking about it because they're growing, they're paying too much in self-employment tax, and they are thinking, what else can I do? An S corporation, it does, I'll go to this next slide real quick, it does not pay self-employment tax, but causes you to start payroll. So like the IRS isn't losing taxes or anything like that, but they are looking for wages.
So you start taking payroll when you have an S or a C corp.
Exactly. Yes.
Okay, thank you. Very clear.
Awesome. I'm gonna look to see if I can, I think I accidentally made an annotation here, so I'm gonna erase that real quick.
I kind of liked that little red mark there.
This is cute, right? Alrighty. So now that we've talked about all our different entity choices, let's talk more about business expenses. And the first thing I want to talk about is profit. So I'm sure everyone's heard of a P&L statement or a profit and loss statement, but I'm curious, do you know what it shows and is it accurate? The reason I ask those questions is I found with a lot of clients is that they just get very overwhelmed when looking at their financials. So I want to be sure that we understand what profit and loss actually means. So to define net profit and loss, that is equal to your gross sales minus any ordinary or necessary business expenses. And we'll define ordinary and necessary on another slide. But there is a difference between your net profit and loss and your taxable profit and loss. And that taxable profit and loss is equal to the net profit and loss we defined above, plus and minus any non-taxable income and non-deductible expenses. So know that the IRS and the other governmental agencies, they don't tax some of your income and they also don't allow some expenses. And we'll get into a few of those here in the next slides. And so this is a sample of part of our financial statements we give to all of our bookkeeping clients. And I just wanted to go over a couple of things to be looking at while you're looking at your own financials. So we'll start with our sales. Especially if you're a cyclical business and you see higher revenues here in the holiday months, you would expect to see higher income in November and December. So we want to see, is that true? Does that make sense with what our business we were thinking was happening? If not, what should we do differently? And is there something we need to change? Similarly, when we look at expenses, A lot of your operating expenses are going to be the same every month because you buy a lot of subscriptions, you pay your utilities, et cetera, et cetera. But payroll, that's one of the biggest expenses for small businesses. So you want to keep an eye out on that one and make sure that you have enough cash to cover your payroll each month and also look for any anomalies. So we see here in May that this was a high payroll month. We want to think to ourselves, was this a one-off thing? Did we hire a lot of people? Is this going to happen as we continue on throughout the year? So just keep that in mind as you're looking at your financial statements. Similarly, as we come down to operating income and loss, we want to look for abnormalities. So in July and August here, we had some large losses. We want to see why. So if we look up through our expenses, we see it mainly comes because of these depreciation expenses. And that usually happens when you buy a piece of equipment, and we'll get into more of that later. But we know, okay, that probably was a one-off. Don't have to worry about it. Don't need to make any changes. Let's just keep an eye on it. And finally, be sure you're checking out for other income. This could come from if you sold a piece of equipment, had an insurance payout, something along those lines. But the biggest line item we want to look at is our net income and loss. And again, we want to check for high income or high loss, see why that happened, see if it's a one-off situation or if that's a pattern. And obviously, if we have a pattern of a lot of losses, we're not making any money, so we want to do something differently. We're trying to see if we can lower expenses at some point. The biggest thing we want to look at, though, is to see our year-to-date income or loss and check it against prior year. Is it higher? Is it lower? Or is it staying the same? From there, you can make better decisions. If your income's higher, we can try to lower it. If your income's lower, we can try to either keep it the same or make it higher, or if we just want to keep doing what we've been doing. And so let's say I have a client who has a pretty high income, that a lot of times they'll come to me and say, hey, should I purchase a piece of equipment? And so let's look at what you can do when you purchase equipment and how it helps offset your income. So the IRS defines a business asset as anything you buy for $1,000 or more, and that has a useful life for over 1 year. And so under IRS guidelines, you would expense the cost of that asset over its useful life, and that's called depreciation and amortization. So let's look at an example. Let's say we buy a computer for $2,000. The useful life of a computer is usually 5 years. Under IRS guidelines, we would take that $2,000 and spread it over the 5 years of its useful life, beginning with the day you place it in service. Now, there's a couple tax laws I wanted to touch on that let you take some or all of the cost of the asset in the year you place it in service. The first is Section 179 depreciation, and this lets you take the entire cost. Now, there's some limitations and nuances, but let's say you have really high income and you bought that computer for $2,000. You could elect Section 179 depreciation and take the entire $2,000 as an expense in 2024, and that will help lower your taxable income. Let's say instead your income's like kind of high, but you think it's going to be higher next year. You may want to not take the entire cost, and you could instead take bonus depreciation. This election, so in 2024, you're allowed to take 60% of the cost in the year that you place it in service. So let's say again, we bought that computer for $2,000. We could elect bonus depreciation, take 60% or $1,200 of that computer, take it as an expense in 2024, then spread out the remaining $800 over the remaining useful life of the computer. So you have a bunch of different options on, depending on what your income is, whether or not you should purchase a piece of equipment or wait until another year, but you have options. And so again, the IRS defines business expenses that are ordinary and necessary for carrying on a trade or business. And it doesn't have to be indispensable to be allowed, but the IRS defines ordinary as something that's accepted in your industry. So if you're a restaurant, obviously food's going to be an ordinary expense. It's not random. And it's necessary if it's helpful for your trade or business. So the IRS wants you to buy things that make sense and aren't random, and also help you conduct your business. Um, Otherwise, they may not be allowed.
Can you give an example of somebody who bought something and that it wasn't allowed?
Yeah, for sure. So a common example is like personal expenses. That one's pretty common sense. But if you're a restaurant and you bought, let's say, like a bulldozer, that's not really accepted in your industry. And you're not using a bulldozer to make pizzas. So that
It
wouldn't be allowed.
needs to relate directly to the business. I got it.
Yep, for sure. And we'll go into some other exceptions here in the next couple slides. So hopefully that'll give you some more things that are like, okay, got it. Can't take these, can take these. So I'm going to go over a couple different types of expenses that clients ask me a lot about. The first one's vehicle expenses, and we already talked about depreciation. So if you buy a vehicle for business, you can take either Section 179 or bonus depreciation, and there are some limits to that. So be careful, you might not be able to take it all, but you can take some depreciation on it. If instead you use your car for business purposes, you can choose in that first year that you place it in service whether to take actual expenses. Those actual expenses would be gas, tolls, depreciation, um, let's say inspections, tire repairs, things of that nature. Or instead, you can elect the standard mileage rate, which in 2024, it's 67 cents a mile. So you can choose which one's better for you. If you drive a lot, usually the standard mileage rate is better because you're getting more bang for your buck. And there's a couple different rules depending on what entity type you are. I won't get into those nuances, but if you have further questions, feel free to ask me later or send me an email, and I'll be happy to give you all that nuance and that detail. Meals and entertainment. So those are definitely hot bucket items for the IRS, and the IRS really frowns upon entertainment. It's usually not deductible, but there are some exceptions. The exceptions are Christmas parties and picnics for your employees. Those are allowed. And then you can also give your clients gifts. That is limited to $25 a person per year. But other types of entertainment, they're non-deductible. Then meals, generally, they're 50% deductible, but they have to have a business purpose. So this is something that you need to keep your documentation for. If you eat out a lot with your clients, make sure you're keeping that receipt, writing who you met with and why you met with them. That way, in any case of an audit, you can show that to the government and say, hey, this is legit. Here's what I did and why. But generally, meals, they're 50% deductible. So you can take half off your taxable income. The other half, you can't count it. So just going over a couple other things you can't deduct: fines and penalties. So let's say you pay payroll taxes late, you can't take those fines or penalties as deductions, as well as anything personal. So your kids' tuition, your boat, your personal lunch, those are not deductible. But what's the best way to lower your taxable income? It's to keep up on it and be sure to review your personal statements to see if you paid any business expenses out of your personal bank account or personal credit cards. And you can set up an accountable plan or an expense reimbursement plan that allows you to reimburse yourself for any business expenses you paid personally. And why is that important? Well, the best way I advise my clients to lower their taxable income is to make sure they haven't forgotten anything. So let's say, for example, you're in the 22% tax bracket and you miss $100 worth of business expenses. You're going to pay $37 more in tax than you should. So you can see that calculation below how I got there. But the best way to lower your taxable income is to make sure all your business expenses have been captured, are in your QuickBooks or whatever you use for your bookkeeping, and that all the expenses you do have recorded are allowable and deductible, or at least you know, hey, my meals, they're only 50% deductible, so you can calculate what your taxable income is. Now let's go on to some self-employed benefits that are available to self-employed individuals. So the first one we'll talk about is retirement plans. And even though a lot of self-employed individuals, they don't have a W-2 job, there are options in order to fund your retirement. And this is a great way to provide tax benefits in the current year while also saving for your future. So I've listed some examples of different retirement types on the left. And there's different nuances on like how much you can contribute to and how you should contribute to it. Some have to be run through payroll, but really my best advice is to consult a financial advisor or financial planner if you don't already have one and work with them and your tax professional to understand what the best option is. But if you contribute to a traditional retirement vehicle, that means you fund the plan or you contribute to the plan with pre-tax money, that can be a tax deduction to you and can lower your taxable income. Now, it's called tax deferred, which means that once you get to retirement, you take that money out, it will be taxable at that point. But hey, if you can get a tax benefit now and then pay tax later, that can work for
Well, and
sure.
theoretically, you'd be making less in retirement than you are now. So
Exactly.
if you can afford to put it in a tax deferred vehicle, and get it later, then you didn't pay the IRS their 37% or whatever.
That's for sure. Absolutely. So, exactly what you said, Deborah. A lot of people expect their income to be lower later in life when you're retired because you're not, making as much, you're not taking as much out every year. So, it's definitely a great way to save taxes now and probably even some taxes later. So, it's a great option.
And I just put into the chat that I did a deep dive with a retirement professional on retirement options for small business owners, and you can find it on our YouTube channel. I'll also send a link in the follow-up, but this is a little bit puzzling. There are so many different kinds. You need to know which kind works for you, but we have done some education on that. So I think that's a really important point. Thank you for sharing it.
Yeah, that's awesome. Thanks for putting that in the chat. Definitely look at that and consult someone who can explain which one's best for you. Because I know for sure that's not my area of expertise. And even when if I set one up, like I have retirement accounts, I talk to my financial advisor and they make it so plain for me. So it's great. Another benefit available are some health benefits. So there's something called a health savings account, also known as an HSA, and contributions to this account can be an adjustment to your taxable income. And so if you contribute, let's say $1,000 to an HSA, that can lower your taxable income by $1,000. And so HSA money, it's invested, your contributions are invested, and then they grow. And as long as you use that money for medical expenses such as copays, doctor visits, medical supplies, that's all tax free. So it's a great benefit in order to save some taxes now and spend money, especially as medical expenses are just going up. It's craziness. So that's a great option. Another thing you can do is take a self employed health insurance deduction. And for this, your business can pay your health insurance premiums, and they may need to be run through payroll, but they can pay for your health, dental, vision, insurance premiums for your family or yourself. And you can also pay for Medicare premiums and supplemental gap insurance premiums as well. And this again, let's say you pay $5,000 in health insurance premiums, you can take that and lower your taxable income by $5,000. So that's a great benefit as well. And there's a couple different nuances and qualifications, but again, just check with your tax pro to see if you qualify. Especially with the health savings account, your health plan has to qualify in order to set that up. So double check that before you start doing anything with that. So finally, we've talked a lot about business tax credits, but I also wanted to talk about some personal tax deductions and credits that are available. I think they're important to not only look at how you can save money with your business, but also as your personal tax as a whole, especially because you're really paying the majority of your tax at the personal level. So the first thing we'll talk about is 529 plans, and contributions to these plans are not deductible on the IRS side. But if you're PA resident, the PA state law allows you to deduct your contributions on your PA tax return. A couple other states allow this as well. You'll just have to check the state that you live in. And these 529 plans, they are used on college expenses. And as long as you're the owner, you can set them up for your grandkid, your kid, your niece, your nephew, your neighbor, anybody, as long as you're the account owner. You don't have to be related to them. But these contributions, it will earn money as they're invested. And as long as the money spent on higher education expenses is not taxable to you. Another credit available is called the child care credit. And then this is a tax credit on money spent on dependents daycare. And this is for children under 13. So if you pay money to the YMCA or some other place for daycare, you can get a tax credit, and it depends on how many children you have under 13 and is subject to some other limitations as well. Student loan interest, I know those are coming back with a fury, and you can get an adjustment to your taxable income for any student loan interest paid, again, subject to limitations as everything is. Personal retirement, so we talked about that self-employed retirement plans, but even if you just have a traditional IRA from, let's say you started it whenever you're 18 or your parents started it for you, if you contribute money to a traditional IRA, you can take that off your taxable income. Another thing I would just briefly mention, if for some reason you think the amount of money you have in retirement is going to be higher than what you have today, you can do what's called a Roth conversion. And this is when you take the money from your traditional retirement account and you convert it to Roth money, which Roth money, Roth account money, it's funded with post-tax, and that money grows tax-free. And whenever you take it out at retirement, it's not taxable to you. So depending on your situation and what you expect, I know we're not genies, we can't figure out what's going to happen whenever we retire, but just know that that is an option. And again, consult a financial planner or a financial advisor. They'll be able to help you best on what you should do. The last thing I'll talk about is gifting options. And this isn't really a tax deduction or credit, but it's a great option to give money away. So let's say you want to give money to your son. You can gift your son up to $19,000 per year in 2025 without filing a gift tax return. He does not pay any tax on that gift, and you don't get any deduction for that gift either. And let's say your wife also wants to give your son $19,000. She can do that. And so you, as a joint couple, can contribute up to $38,000 per person per year. Again, it's a great benefit for the receiver end. So if you ever receive gifts, you're not going to pay tax on that, but you don't really get a deduction. It's just a great way, if you're already planning on giving money away, to know how much you can give each year. The last thing I'll talk about here is some provisions that are expiring. So the TCJA stands for the Tax Cuts and Jobs Act. It's basically the Trump tax laws that got enacted in 2018, and they're currently set to expire here in 2025. Now, with the new election and everything that's going on, no idea if they're going to still expire or if they'll get continued. We'll just see what Congress does. But I did want to go over some different things that are expiring that are really beneficial. So some planning tips right now. The first one I'll go over is the lifetime gift tax exemption. So in 2024, currently, if you're single, you can give up to $13.61 million away without paying any gift tax. Whenever the Tax Cuts and Jobs Act expires, this exemption lowers to $5 million. So if you are a high net worth individual and you're looking to give away some money, consider some estate planning now, so that way you're not hit with gift tax. Gift tax, it's usually higher than your ordinary income tax rate, so you just want to be wary of that. The next one is a qualified business income deduction. And this is really important for all you small business owners, because right now in 2024, you can take a 20% adjustment to your taxable income for your qualified business income. So let's say you earn $50,000 from a business. You can take a $10,000 adjustment or 20% off your taxable income with this QBI deduction. And this is, like I said, currently set to be eliminated. So at the end of 2025, so if you're seeing some big jobs in your future and your income might be up, maybe consider some tax planning now to take advantage of this deduction before it goes away, if it goes away.
Let me just make sure I'm understanding it before you leave that one, because
Yep.
that's a big one for our small businesses.
Yes.
Theoretically, even if it did expire, the tax year 2025, it would still exist. It's not like I have to
Correct.
take that right now while 2024 is still on my calendar.
Exactly. So you have
Okay.
2024 and 2025 to take this deduction. So it's currently set to expire at December 31st, 2025. So once 1/1/26 comes, you're not able to take this QBI deduction on your 2026 tax return. But again, I'm I would expect this is such a big deduction. I would really expect Congress to try to get this passed because small businesses, you guys are the cornerstone of America. They'll say it all the time, but it's true. So I would expect them to try and enact
And
some
with the
tax saving
same
tips.
political climate that existed when they first were enacted, there's a reason to expect it would be reinstated, but you can't, you know, you can't
Yeah,
count on that. Okay.
yeah, absolutely. And Congress is the one that sets the tax laws. Now, like the president can kind of give some say and whatever and try to get it going, but it's ultimately Congress's thing. So talk to your state reps and try to get your senators to pass this because that would be great. The next thing I'll talk about is higher standard deductions. So right now, the standard deduction is $14,600 if you're single. And every year you get to choose between standard deductions and itemized deductions, whichever one's better. Itemized deductions include medical expenses, charitable contributions, real estate taxes, other state taxes that are paid, and mortgage interest. So ever since the standard deductions rose with the TCJA, a lot of people are just taking the standard deduction. But once it expires, those are going to basically be cut in half and go to pre 2018 levels. So if you're thinking of having a lot of itemized deductions, let's say your church is campaigning to kind of create a new building or something and you're looking to give a big contribution. Maybe consider pushing that off until 1/1/26 when it expires, so that way you can take advantage of the higher standard deductions now, and then take the itemized deduction later on whenever the standard deductions are lower. Last thing I'll touch on is bonus depreciation. We already talked about this. Right now in 2024, bonus depreciation allows you to take 60% of the asset's cost in the year you place it in service. But in 2025, it's going to go down and it will eventually go to zero in 2027. So if you're looking to buy big pieces of equipment, kind of consider, am I able to do it now to take advantage of this bonus depreciation? Or you can even combine it with Section 179 depreciation. So make a tax plan, consult your tax professional, so that way you can come up with a plan to get the best deduction for what you're planning on doing in the future. So we just went through a marathon of tax things. So I hopefully you have some tips and you're like, okay, I'm ready to do this. But if you're thinking, I have no idea what I'm going to do, I really would recommend you partner with a trusted tax advisor if you don't already have one. And I would recommend have this person understand your entire tax profile. That means they don't just do your taxes, they don't just do your business bookkeeping, but they understand you as a whole. So that way that they can see, oh, maybe I have a spouse's W-2, maybe I have a rental income. They can make a plan that can use all these things we just talked about and make the best plan that achieves your goals and how you want to grow as a business owner. And I just have a few questions that you should be thinking about. These are things that I go over with my clients whenever we're meeting here at the end of the year. And the first thing is understanding, what is my business net taxable profit and loss? We went over what that looks like, but we should know, am I making money? Am I not? And what should I change, or what do I expect to be changing in the upcoming years? Not only that, but what is my personal taxable income as a whole? And what's my marginal tax rate? And then a lot of things that I go over with my clients is what has changed. The common denominators are, I got married, I had a kid, I bought or sold a piece of property, maybe I got a new rental property or I created a new business. All of this changes your tax picture and it will change the tax plan that I would set up for you and what your trusted tax advisor would set up for you. So that would change maybe some deductions we want to take or kind of plan out what we want to do with the tax year here ending and what we want to do in the new year. Also, we should be thinking about quarterly estimated tax payments. So the government, they want their money and they want it equally throughout the year. So if you're planning on owing tax, you may want to make an estimated tax payment. And that way it evens your cash flow out and it doesn't make you have to come up with like $5,000 in April and you're like, oh my gosh, I don't know what to do. Also, the quarterly estimated tax payments, they help you avoid penalties and interest so we don't give the government more money than they're due. Again, some other things we should think about. Should we buy a piece of equipment? Again, maybe our income's higher and we want that deduction, or maybe my income's lower and I don't need it right now and I could wait until the new year. What credits am I not taking advantage of? Maybe I paid for daycare, but I never thought to tell my CPA about that, and I'm losing out on that daycare child dependent credit. Finally, if you haven't noticed a theme, it's all about planning. What should I look for and what should I do next year? So that way I can be proactive, not reactive, and achieve the goals that I want, either to grow, maintain, maybe kind of back off if you're near retirement age. So make that tax plan and start to think of what you want to happen next year. So as we close, I just wanted to go over some important due dates. So we've got Thanksgiving coming, we've got Christmas, but December 31st, that's the end of the 2024 tax year. It's also the last day to place business assets into service. So if you're going to buy a piece of equipment, make sure you get that ordered here and set up in your office or your store or something, so that way you can take those depreciation items on the 2024 tax return. Then another reminder, if you're a partnership or an S corporation, your tax returns due on March 17th, 2025. You file a separate tax return, no taxes due, it's an informational return to get those forms K1 out to the partners or the members. If you're not ready, you can file an extension and that's valid for 6 months up till September 15th, 2025. And then we all know tax day is April 15th. That's our due date for 1040 individual tax returns, estates and trusts, and C corporations. And again, if you're not ready, you can file an extension that's valid for 6 months up until October 15th. But I do want to really emphasize this. Remember, the extension to file does not equal the extension to pay. The government wants their money by April 15th. So if you think you might owe, try to calculate that out or have your CPA or trusted tax advisor calculate that out and make a payment with extension. That way you avoid extra penalties and interest. We try to do that for all of our clients because it just prevents headaches in the future. But those are all the items I had prepared today. Thank you guys so much for your attention. And if you have any other questions, I'm happy to answer them, or my email's listed. Feel free to shoot me an email and
Yeah,
I can
we're
lead you
gonna
to my
stay
network.
on and answer questions, but let me
Yeah.
officially stop the recording and you can stop the sharing.
Okay.
The first question is,